Good afternoon, everyone, and welcome to today's panel discussion on stranded assets, carbon lock-in, and the clean energy transition. We are excited to be here with you today and to be launching High Water Women's 2021 Accelerating Impact Program. We will be hosting 16 sessions over the course of the next year around this topic, not this topic in particular, for central themes: climate change and climate justice, transitioning to a just clean energy, the impact investment portfolio, and gender diversity and inclusion, investing in the power of difference. And our fourth category is place-based investing. So stay tuned for seeing a lot more from High Water Women in the coming year. In addition to Accelerating Impact, which marks a dramatic expansion of our impact work, High Water Women also believes in supporting and empowering women through our Muriel Siebert campaign for financial literacy, where we train people, a dedicated core of volunteers to go out into the community and teach financial literacy, and our annual holiday gift drive and backpack drive. So I would like to thank our committee, the High Water Women Impact Committee, led by Drianne Benner and Imogen Rose Smith, and also the group of volunteers who worked hard to put today's panel together: Imogen Rose Smith, Melanie Forns, Alex Hybe, Maria Bergenhem, and I think that's everyone. So Melanie, do you want to share with us how we're going to approach today?
Sure. Hi, everyone. So our agenda for today, our session will be discussing stranded asset risk and carbon lock-in and their impact on investments. So we'll start off with a fireside chat with Bob Litterman, then transition into a full panelist discussion. Our panel will then open up to the audience for a Q&A session, so everyone will be able to participate in that way. And of course, before diving in, let's go over some ground rules for this Zoom session. So if you have or need any tech assistance, please message us in the chat function. You can find it just below. You'll also find a Q&A function, so that will come in hand for the Q&A section of today's session. So please feel free to type in any messages or questions you may have for the panelists using that function, and we'll try to get to it during the Q&A session. You can also use the raise hand feature down below too, if you'd like to participate that way during the Q&A session. So now with some ground rules and agenda, let's now pass it over to Imogen Rose Smith. She's our High Water Women Impact Committee co-chair and moderator for the session. Imogen?
Thank you, Melanie. And thank you everyone for joining us today. This is our first session, as Alyssa mentioned, so we're very excited and we're very appreciative to all of you for being here, and we're exceptionally appreciative to Bob Litterman for being our first speaker. So Bob, thank you very much for joining us today. I'm pretty sure everyone knows who you are, but if you wouldn't mind just starting with a little bit of an introduction to who you are and your background with climate change.
Sure, thank you, Imogen, and it's a pleasure to be here. I am Bob Litterman. I have spent the last 30 years working on Wall Street, although my background is as an academic, an economist. I have a PhD, and I taught at MIT for a couple of years, worked for the Federal Reserve Bank, and ended up on Wall Street at Goldman Sachs, starting as one of the early financial engineers. And in 1994, Goldman made me a partner and asked me to head the risk management function for the firm. I am well known for something called the Black-Litterman Global Asset Allocation Model, but I won't be talking about that. What I will be talking about is climate change, and that's a topic that I got interested in relatively late in my career. I was at Goldman, still working, when one of my partners there invited me to lunch. Larry Linden was head of operations at Goldman and is very involved in the environmental space. And at lunch, we talked about environmental philanthropy, and Larry asked me what I was going to do when I retired, and I said I had no idea. But we started talking about climate, and I said, Larry, you know, climate risk, climate change is obviously a risk management problem. And the solution is we need to price the risk. We're not pricing the risk, that's the problem. And Larry said to me, you know, Bob, you know, it's kind of a brilliant insight for an economist, but the problem is no one knows where to price the risk. And I thought, that can't be right. I'm an economist. I can read the literature. Someone's got to have done some work on this. And I started digging into what it turned out was a very interesting problem, and one which had not really, I mean, Larry was kind of right. The academic literature was not great in several respects. And the main one I would say is that it's a difficult problem. The damages are way off in the future, and the question is, how do you balance the cost of mitigating emissions today versus the benefits in terms of very uncertain and distant damages? And the economists who had addressed this, first of all, had not really focused on the full distribution of damages. They kind of said, well, let's assume that damages are, I don't know, you know, some function of temperature, typically quadratic. And then they said, you know, we don't really know how to discount, but if we choose a discount rate like equities, you know, it's a pretty low number. And, you know, then over time, decades in the future, when those damages are closer, the price will be higher. So it suggested a pricing that looked like what some people call the slow policy ramp. Start out today with a relatively low price, and it'll rise slowly into the future until it's more significant. If you think that's the appropriate policy, you don't get too concerned about when do I start, or should I have, I haven't started, I'll catch up. So it doesn't create a sense of urgency. Now, that was inadequate, because when you do take uncertainty into account, it turns out you want to have a high price early on, and then, in fact, high enough that you expect to solve the problem. So it turns out what they were missing was kind of what we focus on in risk management and asset pricing on Wall Street. And assets get a discount factor that's a function of when they pay off and what's the state of nature when they pay off and so on. And so this asset pricing approach, you can view emissions as an asset that has random payoffs in the future. And anyway, it turned out to be a very interesting economic problem. In fact, I got interested in it, started reading the literature, started working on it with some colleagues. And so Gernot Wagner, Kent Daniel, and I wrote a paper that was published in the Proceedings of the National Academy of Sciences just this past year on this topic. And what we show is that when you take uncertainty into account and price these risks appropriately, the optimal policy is not ease on the brakes over time, it's slam on the brakes today. And it's kind of intuitive when you take uncertainty into account. And so anyway, that's how I got interested in climate, and it's kind of sucked me in, so that for the last 10, 15 years now, I've been very focused since I retired from Goldman in 2009, I retired. So for a few years before that, and since then, I've been very focused on climate. I started getting very involved on different boards, such as Climate Central, the World Wildlife Fund, the Resources for the Future, Climate Leadership Council, which, by the way, is the sponsor of the Baker-Schultz Carbon Dividend Plan, which is the leading plan for pricing emissions in the US. I was asked last year to chair the CFTC, that's the Commodity Futures Trading Commission, climate-related market risk advisory subcommittee. That's a group of 35 folks from the financial markets, corporations, academics, nonprofits, that are writing a report, and will present this report to the CFTC pretty soon, sometime this summer. So anyway, that's kind of my background. And talking now about, I think, climate risk and what it means for investors. Well, I think as everyone appreciates, climate risk is a significant risk management problem. And I like to start with some principles of risk management from financial markets that also apply to climate risk. And they're really pretty simple. I don't think they'll catch anyone by surprise, but they have profound implications. And the first principle is simply that when you're managing risk, you have to worry about worst case scenarios. Yeah, I mean, you worry about the full distribution of outcomes, but if you're a risk manager, you're worried about the bad outcomes. And I say worst case, which is often what I used to get asked when I was head of risk management. Bob, what's the worst case scenario? Problem is, in many contexts, there is no worst case scenario. So today, financial regulators and risk management professionals typically talk about extreme but plausible scenarios as a way of kind of a shorthand for a lay approach to some point in the tail of the distribution. Value at risk tries to quantify this mathematically, but conceptually, we want to think about bad outcomes that are plausible. And with respect to climate risk, that's pretty bad. Historically, this has been a very politicized topic. And so scientists who talk about these bad outcomes are sometimes called alarmists and tried to be put in a box. And because there's so much denial out there, scientists have often been also forced into a corner of defending what we know for sure. The real issue is not what do we know for sure, but what might happen given all of the uncertainty. So that's number one. We've got to worry about those worst case phenomena, and that's what risk management is all about. Number two, and this one is maybe not quite as obvious, but I think pretty straightforward, and that is that the purpose of risk management is not to minimize risk. It's to highlight, identify risks and highlight them and basically try to quantify them so that we know whether we're getting paid enough for taking these risks. At Goldman Sachs, when they made me head of risk management, they didn't want to reduce risk. They wanted to control it, to identify it, to quantify it, and then to take the risks that we were getting paid for. And if risks are not priced appropriately, then we know there's an opportunity. We can either sell that risk or buy that risk, and that pushes risks toward an appropriate level of compensation in the markets. But with respect to climate risk, we're not pricing it, so we're certainly not pricing it appropriately, and that's the fundamental problem, and it's the one that we have to address immediately. The third principle from risk management, financial risk management that applies here, is that when you're managing risk, time is a scarce resource. If we have enough time, we can solve almost any problem. It's when we run out of time that a risk management problem can become, a catastrophe. And that's why on Wall Street, when you're a risk manager and you have an issue, it's always an urgent issue. In my career at Goldman, certainly, and on Wall Street more generally, I've never been told, come back next week when I've identified a risk management issue. It's a priority until we get it under control or fixed or resolved. With respect to climate, we've been wasting time. And by the way, I like to highlight to folks that this is a very similar parallel to the COVID pandemic. There was a study out of Columbia just about a month ago that said that a 1-week delay doubled the number of deaths from the COVID pandemic. And, so we have a similar issue going on here with respect to climate, and delay could be catastrophic. And then the final principle from risk management that I'd like to highlight is simply that, as an economist, we often make a distinction between risk and uncertainty. And the distinction we're making is that risk comes from a model. It's something like, it's a metric. So if we distinguish risk from uncertainty, we're saying a risk might be something like a value at risk or a volatility or a tracking error measure. But uncertainty is what we actually manage. It doesn't come from a model. It doesn't assume that the future is going to look like the past. And in fact, we know that every model has its limitations as an approximation. And this is particularly true with respect to climate because we don't have a history here that we can look at. We're doing an experiment for the first time on a complex system that we'd all depend on. And so what is the implication of that distinction between risk and uncertainty? It's that we have to err on the side of caution. If we have models that tell us that the appropriate price for climate risk is $50 a ton on carbon dioxide emissions, then, but the range of uncertainty is $10 a ton to $100 a ton, we have to err on the side of a higher price, not a lower price than what our models say. So I like to summarize this by saying that basically, right now, we're not pricing climate risk. In fact, historically, our foot has been on the accelerator, meaning that the incentives created by society have actually gone in the wrong direction. We've subsidized fossil fuel production and consumption for decades. And now what we've got to do is slam on the brakes. The only brake we have is the incentive that we give to reduce emissions. And, I say that as an economist, but it's not just an economic idea that incentives matter. The definition of an incentive is something that induces a change in behavior. So we need to change behavior, and what that means is we have to change incentives. And the only thing I would add to that is that as an economist, I would argue that in a modern market economy, what changing incentives means is it means changing wages or prices. That's what we all react to. And it's also true that there are other policies that are needed. It's not just that, but that's gotta be at the center of it. If we don't change the incentives, we're not gonna change the flow of capital, and it's gonna continue going in the wrong direction. Now, the optimistic view that I would like to present is I think we're very close to creating an appropriate carbon price in the US. As I mentioned, I'm on the board of the Climate Leadership Council. We expect to introduce legislation on a bipartisan basis this year, and then with a change in administration in the fall, I think there'll be a serious attempt to pass that legislation. And by the way, the support for carbon pricing is nearly unanimous. There are very few people today actually who don't understand this. The Democrats just last week, released a House report. Carbon pricing was at the center of it. As you may know, with the Climate Leadership Council proposal, which was written by two elder statesmen, Jim Baker and George Shultz, elder statesmen from the Republican Party, but is a bipartisan approach. We have support from everyone from ExxonMobil to the World Wildlife Fund and everyone in between. So there's a lot of support for this. And I think, it remains unclear, but I wouldn't be surprised to see this passed under a new administration next year. And the rest of the world is ready to move forward. They're waiting for the US. And so there's good reason to believe that an appropriate incentive to reduce emissions, which is to say a high price on carbon, could come very soon. And this means something for investors because while the impacts of climate change will continue for decades, the transition to a low carbon economy, which really has to be a phase change in economic activity, is going to start soon. And it's very likely that investor expectations about that are not yet where they need to be. They certainly have changed. And Imogen, if we could maybe bring up, there's a couple of slides I wanted to refer to.
Yes, I think Alyssa has those. Alyssa, can you?
Okay, so one of the things I wanted to talk about was this, this slide, which is this is a historical returns. I don't know if you can all read the dates on the bottom, but at the World Wildlife Fund, we implemented a stranded asset total return swap about 7 years ago. And these are the returns from that swap. Let me explain what it is. I was chairman of our investment committee then, and a number of the trustees wanted to divest the fossil fuels, but we discussed it, and our advisor told us, you know, you only have, less than 1% invested in what we called stranded assets, coal and tar sands initially, and then also fossil oil production. In any case, they said, there's so little here, don't worry about it. We said, no, you know, we're the World Wildlife Fund. We want our investments to be aligned with our mission. And they came up with this idea, which we really liked, which was basically not to disturb the underlying portfolio. And many of these assets were quite illiquid, but rather, and distributed throughout the portfolio, but rather sell them out as an overlay to a counterparty, and then receive in return the market return. So basically, it was a way of eliminating them from an economic perspective from our portfolio without encountering or paying the transactions cost. So I thought it was, you know, a nice idea. It was very cheap to implement. And I thought, you know, it's very likely these stranded assets will underperform the market, so we might make some return. I had no idea what to expect, but as you can see, and I don't know if you can see very clearly, but over this 7-year period, we've had 132% return on this swap. What that basically represents is the long side, the S&P, has basically doubled over that period. And the short side, which is a basket of coal, tar sands, and oil exploration and production, that basket has not only underperformed the S&P, it's actually lost about 30% of its value over this period when you take dividends into account. So the total return has been negative over a period where the S&P has doubled. And on this graph, we can see some of the events that occurred, but in particular, toward the right side of the graph, you see the volatility induced by the COVID shutdown and the big spike up in terms of the swap as fossil fuels underperformed, as oil prices collapsed, and then a lot of volatility and really a reversal of a lot of that as the market came back over the last month. So June has been a very volatile month for this stranded asset total return swap. But bottom line is it's up 130% to date. It's done very well. And I think it reflects expected, you know, more rapid transition to a low carbon economy, but it's just the beginning. Now, if we can go to the next slide.
Go ahead.
Yeah, how are we doing on time? Just, okay, I'll be done in a minute or two here. But at Kepos Capital, where I work, we're now launching a rapid transition fund. We think it's, we think that this trend of underperformance by fossil fuels is what we sometimes call version 1. It's sort of the obvious, simple approach to positioning a portfolio for a rapid transition. But we think that there's many more things that can be done. We think call it the physical risks will play out over decades, and frankly are already being embedded in valuations, for instance, of coastal properties, properties in flood zones. In you know, in California, it's hard to get fire insurance anymore, so those homes valuations have been dramatically affected, and so on. But also, in particular, we think over the next 2 to 5 years that there will be a rapid increase in expectations of policy, and the appropriate policy is pricing of emissions, and that's not a smooth transition. That's a transition that frankly hasn't started yet to any significant degree, which I'll show on the next slide, but which we anticipate will rapidly increase as we price carbon in the US. If we can go to the next slide. What we're looking at here is what we call a carbon transition barometer. And it's basically an attempt to measure on a globally average basis, what are the incentives to reduce emissions and how are they changing over time? And you can see on the bottom of the left hand here, 10 years of average emission pricing. So what we do is we go across 40 countries, representing 94% of total global emissions, and we ask, what are the incentives, both positive and negative, to reduce emissions? Historically, there were strong incentives to produce and consume fossil fuels. In recent years, there have also been strong incentives to reduce emissions through renewables and renewable energy. And then we have some carbon taxing. It turns out, though, that when you look at carbon taxes around the world, they do exist in many venues, but they're incredibly low. The World Bank estimates that the average carbon tax globally is about $2 a ton, where it exists, which is certainly not in all venues. And so when we add it all together, though, the subsidies to fossil fuels, the taxes on fossil fuels, which actually are quite significant in many cases, not always due to climate concerns, but we include, gas taxes and so on where they exist. We look at renewable subsidies, renewable portfolio standards, feed-in tariffs, other subsidies, ethanol, and so on. And we add it all up on a globally average basis. And what you can see here is that the current price per ton of emissions is $11.62. We also break it down by country and so on, but that's the globally average price. It's much too low. The right price is probably closer to $100 a ton, although in the short term, we're probably going to get to something like $50 a ton. And we think that that will really create a phase change in the economy. It will cause appropriate actions by consumers, by investors, by the capital markets, by entrepreneurs, and so on. So it will be a profound change. Right now, as you can see on the right-hand side of this graph, emissions continue to go up. And in fact, if we look over a longer period of time, you'll see that emissions are growing today at the fastest rate that they have, that is before the COVID. And now a lot of people think emissions may have peaked, and that given COVID and given forthcoming actions to increase this incentive to reduce emissions, we may actually have turned the corner. But I would just end on a cautious note, which is that it's not the emissions that create the problem. It's the level of CO2 in the atmosphere. And even if we peak emissions today and bring it down to net zero in 2050, that's when those emissions, that's when that CO2 in the atmosphere peaks. And the peak temperature, because of lags, won't come for maybe 20 years after that. So we're talking about a peak temperature that's baked in the cake, no matter what we do today, at somewhere probably between 1.7 and 2 degrees C. And here's the really scary thing, is that every 10 years that we delay, that peak temperature goes up by about 0.3 of a degree centigrade. And scientists have told us that, 2 degrees is really quite dangerous. In fact, the IPCC wrote a report about the difference between 1.5 degrees and 2 degrees. 1.5 degrees, they say, will cause us to lose something between 70 and 90% of coral reefs, just as an example. That's at 1.5 degrees. It's too late, by the way. We're going to go above 1.5. So it's going to be worse. And what they suggest is at 2 degrees C, we're going to lose over 99% of coral reefs globally. And that's where we're going to be in about 6 or 7 years, at 2 degrees being the best case scenario. So I think we are going to wake up. This is insane, not pricing this risk. We're going to price it appropriately, which is at a high level, and that's going to make a rapid transition begin, and that'll change valuations of securities, especially in the energy industries, but really across the economy. So I'll stop there and hopefully start a conversation.
So we have a question from the audience already. So I'm going to ask you that question, and then I have a question, and then we'll bring in the rest of the panelists.
Okay.
So the question from the audience, which I think you have in the chat as well, is will Paris and the NDCs drive this impact, by which I assume the carbon pricing barometer, to 100, assuming US re-enters Paris post-November? What will be the driver? So that's technically 2 questions.
Yeah, Well, Paris is not adequate, but Paris is certainly part of the solution. We need global cooperation, and that's one of the very significant frictions that has caused us not to respond appropriately. But as I said before, my view is the rest of the world is ready to move forward, is waiting for the US, and there are a number of good ideas for how to enforce global cooperation. And it's not really the UN process, although, you know, that's part of it. But for instance, the Baker-Schultz plan, the carbon dividend plan that we're proposing, includes a border carbon adjustment. Europe is also debating a border carbon adjustment. What these adjustments mean is that we will charge a tariff on imports of high carbon goods from countries that don't have similar incentives to reduce emissions, carbon prices. And if you're, let's say you're a country somewhere that doesn't have a carbon price and you want to export to the US or to Europe or any other country that has such a border carbon adjustment, then that country is going to charge a tariff and collect those revenues. Versus if you have your own carbon tax, then you get the revenues from that tax. And so it creates a strong incentive for other countries to join the block of countries that do have appropriate prices and incentives and an adjustment. Sometimes this is called a carbon club, but anyway, the idea is if the US, Europe, and China are all able to create strong carbon incentives, carbon pricing, and border carbon adjustments, there's a very strong incentive for everyone else to do it. And that could easily lead to a globally harmonized, pricing regime. I think it's also, I think aviation has an important role here to play because aviation is an industry that has a high carbon footprint. It needs the capacity to emit emissions for the next 50 years. They have no cost-effective way of reducing emissions. And so it's in their best interest to create a globally harmonized carbon price. And so they're ideally positioned to do that. So there's a lot of aspects to this problem that's complex, and the global coordination problem is one part of it. But let's just say the UN to date has not been up to the task, and the NDC approach of the UN is nowhere near adequate to get the rapid transition that we need.
If in the event that you are wrong about the idea that there is going to be a price on carbon soon, obviously that has implications for the, terrible implications for the broader climate crisis. But what does it mean in terms of markets and investors? Because it seems like, if you go back to your World Wildlife Fund swap, it seems like that the capital markets are starting to move in this direction, absent policy and absent a price on carbon. And presumably, back to including your aviation example, if there is not consensus around the price on carbon in the US in the next 4 years, there is, one would hope, going to be movement elsewhere. And that in turn will have ramifications that will have economic ramifications and ramifications for investors.
Well, there's a lot of uncertainty about future policy, and a lot of expectation has been built into the market. So I would say you're raising a very good question, or whoever raised this question.
That was my question.
Okay, it's a great question. Is it all built in? And what if you're wrong? And of course, the answer is, yeah, who knows? There's lots of potential outcomes out there. And I would say most investors are much less optimistic than I about the potential for a rapid transition to get started very quickly. Although I think those expectations are rising. And so at any given point in time, there may be new, all kinds of shocks to the system. No one anticipated the COVID pandemic. That was certainly a huge shock to energy demand. and we've seen, you know, the impact on prices and so on. But I would say that while there's some risk, there's risk that it will happen. And so, you know, I think one should protect their portfolio. I think it's just starting, and I don't think it's all priced in, because I do think most investors are much less pessimistic than I. And in particular, I would say, and I do a lot of talking to major institutional investors around the world, they do not anticipate a phase change in this area. They think that it's a very slow slog that's going to take, you know, a long time before we have significant incentives to reduce emissions. And we're certainly moving at a very slow rate, and that's why emissions continue to grow. When you see the reality of this situation and the risk and the urgency and the cost of delay, you realize we do have to slam on the brakes. And I think it won't be too surprising when a year or two from now, everyone wakes up to the gravity of this situation, and we are pricing emissions and creating this phase change in economic behavior, a very fundamental change that valuations will have changed significantly from where they are today. And I encourage all investors to position their portfolio appropriately. I talked about stranded assets, but there's all kinds of opportunities in terms of investments in renewable energy, in terms of, I think one of the best investments is the carbon allowances that trade in Europe, in California, RGGI states, and you know, these are going to go up in value significantly. And then there's also, you know, high quality offsets. If we're charging $50 a ton to someone who puts a ton of carbon dioxide into the atmosphere, we ought to pay $50 a ton to someone who pulls it out. And there are a lot of ways through natural climate solutions, built, you know, planting trees, etc., changing things, the way we do agriculture. There are ways to reduce emissions significantly, and people can get paid for those. So these are all things that provide opportunities for investment, as well as opportunities to hedge risks of existing stranded assets.
So we have tons of questions lining up for you in the chat, but I want to bring in the rest of our panelists at this point because they've been waiting patiently. So if our other panelists could turn their cameras on and join the conversation, that would be great. Let's see. I'm going to have all of you just briefly introduce yourself, and then we'll go to questions, and then we'll have a more wide-ranging conversation. So Maria, as the institutional investor in the room, and therefore the most important person, do you want to start by briefly introducing yourself?
Sorry, I muted myself. I'm Maria Garrahan, and I work for Massachusetts Pension Reserves Investment Management. Very long name, but we tend to go by MassPrim, or Prim for short. So I am actually building out the research team in MassPrim, and one of the research long-term initiatives is relating to ESG. And so I know on this panel we're talking specifically about stranded assets, but stranded assets fall within the E section of ESG, environmental, social, and governance issues. And so this project is, has been really interesting, and in the sense that there is institutions, institutional investors, sell side, buy side, across the industry that has been working on these issues, potentially some for decades. And at MassPrim, what we set out to do last year was to look at the past practices and current practices across the financial industry to be able to assess what are the lessons learned and which lessons we should take and try to create within our ESG framework at Prim. I think one of the topics that really, or views that everyone has as an institutional investor across the board is that whether it's the environment section or just ESG as an aggregate, ESG is different for different people, and also it is the way that one would implement it may be different for one institutional investor versus another, given different fiduciary objectives or whether they're a long-term investor or a short-term investor. So I think for us, being able to understand overall what the industry has been doing and thinking about helped us shape something that was really a customized approach for what would work with mass prim and our fiduciary objective.
And your major objection and a major objection and a major concern that you have raised with me before is the quality of the data, right? You guys clearly recognize that climate change is a risk and that there are climate risks. What are your data objections, and what does that mean?
Yeah, so I guess when you think about the data issues, specifically to climate change and climate related issues, when you think about the greenhouse gases, there's 3 different scopes. And the first scope is direct emissions. So direct emissions by, let's say, like there's a company that's producing coal, manufacturing coal or oil exploration, right? You can look at the capital expenditures for the most part and be able to understand the emissions or the carbon footprint associated with that. But when you're thinking about this this long-term view of how we're going to implement different investment strategies, we're trying to think about the other 2 scopes as well. So let's say scope 2, which is, let's take me, for example, the amount of carbon, the amount of electricity that I use in my home, right? That's the second scope. And the third scope is even more indirect. It's like, how do you commute into the office? So like when you're thinking about giving a company a score, what are the different commuting policies that they have? This becomes very complicated in being able to capture the risk associated to carbon. When you try to extend it from scope 1 to scope 2 and scope 3, which ultimately needs to be part of the longer term vision on the research front. So really, I would say the issues for me are just like in terms of coming up with a long-term plan, things must continue to evolve and become more consistent in the reporting structure across all of the different scopes.
Thank you, that was helpful. And I want to come back to this data question in a moment, but I want to bring in Tracey Cameron from Ceres. Tracey, can you briefly introduce yourself and sort of explain where you sit in your ecosystem? And then I want to go to the slide that you have, because I think it is relevant both to what Bob and Marie have been saying, and then I have a question.
All right. Thank you at the outset for having me. And Bob, that was wonderful. I could have listened to you all afternoon. So I'm the Senior Manager for Corporate Climate Engagement at Ceres. If you're not familiar with Ceres, Ceres is a sustainability nonprofit. We were founded after the Exxon Valdez spill in an effort to look at how people could use their investments to influence corporate behavior. And since then have grown to be a really powerful force in building sustainable markets. We work with very large investors across the globe. We work with companies, we work with policymakers, and really try to move the industry, the capital markets, to be more sustainable. I work on the climate and energy team. We have a lot of other focus areas, water and food and forests, but I work on climate and energy, and I work on carbon asset risk. I work with investors with about 11 trillion in assets under management who are really engaging the oil and gas sector in particular. So really pushing companies in the oil and gas sector to talk about their plans to decarbonize and how they're going to align with Paris. So I will stop there.
Well, actually, I wanted to bring up, Alyssa, can you bring up Tracey's slide? There you go. So you have here all of the write-downs that recently happened in the oil and gas sector. So this seems to sort of speak to this question of, well, not so much, are the markets already pricing this risk in? so much as aren't investors starting to, does this show that the sort of the efforts that, you know, Bob Litterman and others have been doing on the research front and the policy front are starting to bear fruits, and also the efforts that shareholders have been doing in terms of engagement are starting to bear fruit? And B, does this show that the risks are already hitting both company balance sheet and investment returns, absent the sort of policy movement that's necessary? So easy question.
Yeah, you know, the risks are being felt, and, you know, long before COVID and the demand hit, the oil and gas sector was experiencing a lot of stress. It was having low margins. It was, you know, hitting rising cost of capital. Their credit ratings were being impaired. So even without policy, I think that a lot of this is being built in. There was a study recently that said something like, you know, in the last decade, the oil and gas sector has paid out over $216 million more than it's taken in their free cash flow. So they, you know, it just isn't a model that is working, which is why companies are finally having these numbers hit the balance sheet. And it's come from a lot of areas. The investor pressure, certainly through, we support Climate Action 100, which is a global effort by investors. We have 40 trillion in assets under management, engaging the 160 companies who have been identified as the most responsible for emissions and can have the most impact in changing to a low carbon economy. So that has had a lot of impact. Investor resolutions has been helpful, but also the business cases there. You know, the cost of renewables is so favorable. If you were building out an economy now with the same technology that you have in renewables and fossil fuels, it would be a no-brainer. You would just go to the electrification and the renewable energy. So that's helping enormously as well.
Thank you. That was helpful. So at this point, I want to bring in David Wood, who has been waiting patiently. Thank you, David. So you do, first of all, please introduce yourself and say a little bit about what you do, and then I have some questions, and I believe you have some slides as well.
I do, if you want to use them, but we don't have to. Hi, everybody. Oh, look, they're up. You do. I'm David Wood. I work at the Initiative for Responsible Investment, which is a small applied research project at Harvard Kennedy School, and we've been around for over 15 years, kind of studying responsible investment broadly construed. In the context of this discussion, I've spent a lot of time over the past 10 years or so with labor-affiliated pension fund trustees, first in the US and then globally, thinking about climate change, but also thinking about the just transition and the social issues implicated in a low-carbon transition of the speed and scale we need, as Bob laid out earlier.
So in a second, I want you to unpack what we mean by the just transition. But before we do that, how do, you know, organized labor plays an interesting role in the carbon movement. It's not as clear cut as it was, say, in the South Africa apartheid divestment movement, which had a clear labor component to the activism there. How do labor trustees feel about climate change, and what is it, is that changing, and what is it that they want to see their pensions doing?
Yeah, and so I don't want to speak for labor, and I don't think there's any sort of universal view on the communities we talk to, either with pension fund trustees or we work with foundation endowments or family offices. I mean, I think there's fairly common thoughts across the board. Certainly the risks of stranded assets are on people's mind. I agree with Bob that most investors don't really see a phase change. And so those risks are still, you're able to sort of put them off into the distance. And, you know, the whole sort of the way that responsible investment was conceived as a set of information that's out there that will be processed by an efficient market actor, it kind of takes investors a little bit off the hook. They're not the agents of change, and so they're waiting for some other agent to change the circumstances in which they invest. You know, I think you have an urgency around the topic, but within the responsible investment community, there's, you know, still some dissipation on where to act outside of shareholder activism, where I think Climate Action 100 Plus really has, as Tracey said, given a kick.
So yeah, and I totally take on board your point about not speaking for organized labor in its entirety. But do you think that, given what you just said about sort of the idea that the market's efficient market theory, and that somehow the problem will be taken care of, and that it is not the responsibility of the investment office to play a role, and, you know, arguably investors will and have said, you know, that it's their fiduciary duty not to do certain things. Do stakeholders, are you seeing stakeholders, does the voice of the stakeholder become more important? And are you seeing stakeholders express, I think you're seeing sort of stakeholders, including trustees, express increasingly levels of concern and urgency about this. And does that start to have an impact?
Absolutely, and I think that, so let me just talk about the just transition for a second, because that's the topic I'm filtering that question through. What just transition is very hard for investors, right? It's a holistic view. It has a couple implications. So if you think about what we need to, in 10 years, make a significant dent in this massive change in energy use and all its ramifications, it suggests that, you know, investors will not be the leaders in order to make this change. This is a whole economy problem. It's going to take significant industrial policy. I mean, I'm totally on board with $100 plus for a carbon price, but I think pricing right now, it's a necessary but not sufficient element. There's too much to do too fast. And that puts investors in an odd place, right? Because they're not the ones who are going to have all the money or direct all the capital, but they play a really important role within this broader community of stakeholders. Just transition does a couple of other things. One, it raises the issue of social cohesion. So we're not going to get a transition if we have a political breakdown because people don't support everything that has to be done to achieve the scale and speed we have to achieve. That means we have to think about the workers who are displaced, the kinds of jobs that are being created. If you go back to that second slide there, you know, just transition is in the Paris Agreement as part of what the International Trade Union Confederation and the ILO sort of were part of those discussions, because, as you see, you know, in France with the yellow vest, we couldn't even have a council of parties in Chile because people were protesting in the streets because of a dissolution, you know, of social cohesion. Just transition calls society into play, which is really hard for investors, but I think really important. So what can they do, right? Well, investors can engage companies on their issues with how they treat workers, how they treat especially marginalized communities. In the US, the effects of the transition are right now racialized in a way that really puts a disproportionate burden on marginalized communities, indigenous and Black communities, I would say in particular. So investors can engage companies on those kind of policies. We've been working with ICCR on engaging utilities, sort of how they sort of think about workers and communities in the present. They can reallocate capital in different ways, which in the case of the pension funds we work with means adopting responsible contracting policies so that the new jobs in renewables aren't casualized $15 an hour seasonal jobs, as opposed to the $40 an hour with good benefits jobs that people are leaving. But I think just as importantly, to get to your stakeholder question, investors are one stakeholder among many. They need to be at a table, an unfamiliar table with different kinds of civil society organizations and government and business and labor, talking about what kind of policies we need. And those policies won't always just be about incentives for investors, or at least I take your point, Bob, on what incentives means broadly. It's not going to be a bunch of tax expenditures for investors that are going to fix this alone, right? And so investors have to have a different kind of discussion about policy that really talks about this sort of expansive view. And the last one, if you go to the last slide, I think a lot of the interesting work that's going on around just transition now is coming out of the environmental and racial justice communities. focused on really sort of place-based, because the transition is going to be felt or experienced in place, working on ways to get those most affected by the transition, those without power who are likely to be left behind by the transition or to bear its costs, to have not just a seat at the table, but some kind of power when their voice is heard. And investors can play a role in supporting that. But that's, again, a pretty unfamiliar role. And I think you find that sort of in the margins of the impact investing community and engaging in the environmental justice community. You see some models emerging for what that looks like. So there's a lot of things investors can do, but they're not going to take the lead. And one of the things that I like about the Just Transition Project is it really calls responsible investment to account. If we really mean this is what has to happen, investors have to step up in ways they haven't in the past.
I mean, it's interesting because, I think that the Just Transition Project, if investors didn't think that, it was their responsibility or their need or their job to think about climate change until, Bob and others started doing this work, and obviously, Ceres and others as well. And so really the last 10 years, a lot of the stuff that the Just Transition is talking about still seems very fuzzy and not part of their day job to a lot of our friends, the institutional asset owners. And so, does that, and I was going to put one of you on the hook to explain in simple terms what actually stranded asset risk means. But it also seems like, so if stranded asset risk is effectively in very, very simple terms is, the risk of having stranded fossil fuel assets on the books of companies that can, I knew that was going to happen. That was the risk of my dogs, and I bet you that's the FedEx guy, because I knew this was going to happen.
I'll just ask whatever question I wanted you to ask.
While I'm dealing with this. My question is, are there other risks? So effectively that is, somebody else can do an explanation of stranded asset risk that doesn't involve dogs. Effectively, my question is, are there other risks that we can see that are associated with climate change that may have financial implications, including social risks? So specifically, I was going to put you on the hook about the Dakota Access Pipeline decision, which is arguably a recognition of a social movement that can have financial implications.
For sure. So, I mean, the simple answer is, yeah, there are all kinds of structural, but these are systemic risks. They're not going to be easy to quantify. But what happens when the policies create a political climate that we put in, incompetent reactionary politicians who create great social turmoil? That has obviously massive implications for investors. It's awfully hard. It's hard enough to get the climate risks quantified, but it's a major risk. And it's one that I think that's what we have to step up for. The thing about the pipelines, it calls into question this broader stakeholder thing, because that's a case where the politics is what strands the assets. It's not sort of a realization finally that we can't keep the oil into the ground. It's that people on the ground, indigenous-led movements and environmental justice-led movements that created the lawsuit, created the conditions whereby assets become stranded. And if that's what we need those, the stranded, we don't want stranded workers. We don't want stranded communities. We need the assets to be stranded. And I guess for me, what this raises is, given the systemic risks of what happens if we don't strand the assets, what's investors' role in creating the conditions whereby they are actually stranded?
Isn't there also, in a sense, sort of both an opportunity cost and a decision to be made here? Like I have a choice, more often than not, I have a choice to invest in a pipeline in a way I don't necessarily so much in Exxon, right? So why don't I go ahead and make the choice to invest my capital in ways that it's not going to be stranded? I'm not necessarily, that's why I'm saying, like, I'm not necessarily saying, divest from fossil fuels. Maybe I could decide to do that. But at the very least, make a conscious choice to at least where I'm making active allocation decisions, allocate away from, you know, fossil fuel and stranded assets towards renewable and other just investments.
Yeah, I mean, I would love to hear the others.
I was going to bring the rest.
I could listen to them all day long, as Tracey said, but even more, I could listen to myself like all week long. But just, you know, I buy the business case in its long term, and I buy a sooner phase shift than investors now expect. So I think there are all kinds of reasons to think strategically about where you're putting your money. I just want to emphasize this other side of that, which is that only happens because of active participation in politics. That's what's going to bring about these changes, and investors have a role in that too. So yeah, for sure, I think you should get out of companies that are going to fail because they're not positioned for the future and go towards those that aren't. But you should think about the systemic implications for workers and communities when you do that, and you should participate in a political process which makes that, you know, a just but also effective transition.
So Bob, I want to bring you back into the conversation. And I know the audience has questions of you, and I'm sure that the panelists do as well. But I want to use the moderator's privilege to ask the first question, which is, you know, how do you see the work around the just transition factoring into the work that you do?
Yeah, well, I don't disagree with anything David said. I think it's very important that this transition be just. And in fact, the COVID pandemic has just highlighted for all of us how, you know, these systemic risks hit the, you know, low income and the marginalized communities, and, you know, the racial impacts that, you know, that are totally unfair. But having said that, and I don't, you know, don't push back on any of that, but I would say that, you know, issues such as income inequality and these kinds of, you know, systemic racism and so on are issues that have been with us a long time and will remain with us a long time. And climate is right now a risk management emergency, and we have to address it. And immediately, I mean, it's, you know, and so we should address it in a way that is fair. We should address all of the issues that have been raised by, you know, those who are concerned about these other issues. And we certainly don't want to make them worse. But climate change on its own is going to impact the lower income folks, not just in the US, but around the world in a very unfair way. And so it's all wrapped together.
Does anyone on the panel have questions for Bob or for each other? David, I'm sure you do.
Well, Imogen, if I could respond to...
Oh, please go ahead.
Yeah, I mean, something that Maria said, which I totally agree with, which is that the data and analytics that we have to understand climate change and incorporate it into our investing is totally inadequate, and it has to improve dramatically. And there are many initiatives around the world and in the United States to try and gather that data, to create standards, to create, you know, a platform for this type of analysis. But one thing, and Maria focused on scope 1, scope 2, scope 3 emissions. One thing that I would say is that when you look at, and for instance, I've been trying to figure out which of these, you know, oil companies are most likely to have a revaluation downward, you know, so which ones are most stranded, because obviously those are the ones I kind of want to focus on. And when you look at that analysis, you know, that has a lot to do with exposure to lower oil prices, because if we have a rapid transition, that means that the demand for oil is going to be lower in the long run than we expected. And so if you're someone like Saudi Arabia and you're sitting on a reservoir with 80 years supply of oil at current production, you're going to say, you know what, I'm not sure people are going to be buying my oil in 80 years or in 50 years. And so the price of oil might be quite low. I better sell more of it today when it's more valuable. That, of course, lowers the price today. So my point is, it's not just in the distant future. Oil prices are likely to be low from now on. There's plenty of oil out there. There's not enough, space for the emissions is the problem. And so what that means is, oil companies that have high costs of production, oil companies that have reserves in the distant future, so there's all kinds of analytics that you can do. We work with a company called Rystad Energy that for something like 60,000 oil and gas projects around the world will tell you what are their exposures to, and for instance, we look at a decline in the price of oil and also a high carbon price. Well, it turns out most oil and gas companies do not have a lot of exposure to high carbon prices. They have very little direct emissions. The impact of high carbon prices is going to be on the demand for oil, which feeds into their lower oil prices, and that's what's going to impact them. So if I'm an investor trying to figure out which oil companies do I want to short, I don't look at what are their scope 3 emissions. I look at what is their sensitivity to lower oil prices today. And so that kind of, I'll call it fundamental analysis, although I come from the quant investing world, that kind of fundamental bottoms up analysis is the kind of analysis that we as investors need to do. And so we have to, step back a little bit from sort of traditional ESG metrics that may or may not be relevant in a particular situation of investing. And I just think that all investors should be thinking very carefully about what are going to be the impacts of rapid transition on energy prices, on demand for carbon allowances, on demand for offsets, et cetera, for airlines. Airlines, by the way, are pretty exposed because they do have a lot of emissions. And by the way, it's not just CO2 emissions. I read an interesting paper from MIT that says that their NOx, their basic pollution has health impacts that if you price them are just as bad as their carbon emissions. And if you take both of them together, the actual negative externality of flying doubles the cost of an airline trip. And so this is a big exposure from the airline industry, for the airline industry. Another point that was raised, I think you did, Imogen, what are the other risks besides transition risk? There's certainly all the physical risks, but also there's liability risk. And that's something that I think is underappreciated. I don't think the oil companies are going to be liable for historical emissions, but I think that if they have spent money to intentionally create disinformation about the severity of this risk, about the risk of their reserves, of being stranded, et cetera, that can create legal liability as well. And there's an awful lot of lawsuits that are being filed these days looking for, the liability that has come historically from those kinds of activities.
So effectively, part of what you're saying is that you don't think the scope 1, 2, and 3 carbon emissions is a particularly useful metric from an investment and even necessarily a risk standpoint. Is that fair, or is that too harsh?
I mean, basically, yeah, but total emissions, don't get me wrong, are an important metric of where we're at and how we're making progress. And if I'm interested in risk management of financial markets generally, or the economy more specifically, of course, I worry a lot about what are total emissions. But yes, I'm saying if I'm interested in what's the risk of ABC company versus DEF company to pricing emissions, it's not necessarily the scope 1, 2, 3 emissions. I have to do a deeper analysis of what's going to be the impact on this particular company.
And Maria, has that been your experience? Sorry.
I was going to jump in. There is a lot.
I was going to ask you a question, but jump in and then I'll ask you a question.
Okay. So Bob, no, I mean, you raised a really interesting point, and I think for me, I use scope 1 and scope 2, looking at direct versus indirect emissions as just one example. The space is extremely complicated. And so what we're trying to do at Mass Prim is think about this in a very measured approach. And when I say measured approach, it means a few different things, right? Like one of which is, how do we deal with all of these complexities when you're seeing the industry want to apply this top-down approach, for example, ESG, when there's so many different things happening, and we don't necessarily have a conviction and the ability to measure the different sub-factors, right, within the environmental section, one of which could be, the scopes and the emissions, but there's all the physical risk, right, and pollution as well. So I completely agree with you on that, and I think that's, when I think about the data issues, that is one of the biggest concerns I have, is that there is it's such a wide range of activity that we need to focus on to be able to create something that we have conviction that we're capturing, right? And so when you start to get outside of the realm of emissions, how do you deal with that? How do you have conviction in the quality of that measurement? I know that there's definitely different initiatives out there. There's lots of data providers in the space, whether it's ESG in particular, or focus specifically on environmental issues. But we need to be able to make sure that we are measuring the thing, like that object, correctly. That's the problem.
Yeah, no, I totally agree. And it is very complex, and it differs by industry and so on. I just pick on emissions because it's sort of a good example of where, you think there's a metric here that I should use, and like most quants, what we would typically do is look at historically the relationship between X, Y, or Z and returns. But this climate in particular is tough because we haven't experienced it before. Unlike most types of investing, where you'd say, all right, let's look at the metrics and how well they are at forecasting returns. It may not be that they were at all relevant 5 years ago or 10 years ago. They're going to be super relevant in 5 years or in 10 years. So I really think it's more akin to fundamental analysis and really going industry by industry and firm by firm and thinking about what are the risks, both physical and transition and legal, that face a particular company at a particular point in time. And that's not at all obvious. If we look at probably the biggest climate-related corporate bankruptcy, PG&E, it wasn't obvious that they were highly at risk. I think we're all a little bit more sensitive to wildfires and the risk of increasing wildfires today. The other thing I would say is a corporate disclosure on climate-related risks, and that's something that we're focusing on at the CFTC subcommittee. That's at a very early stage. There's not a lot of comparability. There are a lot of attempts, like the TCFD, the Task Force on Climate-Related Financial Disclosure, that has made some suggestions on what should be done. And Ceres, by the way, has been terrific on this. So thank you, Tracey, for that. And Mindy Luber is on our subcommittee. So we're making progress, but it's all at an early stage, and we have to make rapid progress in the years ahead because we're really just at the beginning.
David has very patiently raised his hand and has a question. David, what is your question?
Well, so I just want to follow up this discussion with Maria, but also maybe with Tracey. Given the challenges, one, in measurement and incorporating that, first you got to measure, then you got to incorporate that information into your decision-making process to change decisions. And we have such radical uncertainty about what's going to happen, especially in the policy environment that's really driving a lot of these risks that we're talking about. How do you all balance this sort of, we need better information to make better decisions and better disclosures so we can sort of work at the margins versus more blunt instrument well, you can't afford, PG&E turns out to be a blunt instrument, not a sort of very fine detail problem. So how do you balance that sort of, deep information environment with so much uncertainty when you're making the business case?
So I can jump in here, and I think this is where the measurement becomes really important, right? Because we don't have these regimes or the historical data, like Bob was talking about, to be able to really do back tests based off of what has happened previously. However, the first thing that we need to do is have confidence in what we're measuring. Like for example, let's say, water quality, right? If we think we're measuring water quality and we create some sort of quantitative analysis based off of, how different companies are scoring on this measure of water quality, the problem is, what if that water quality measure is wrong, right? And then you're not actually capturing that long-term premium associated with it. So the problem is, like, the first thing is getting the measurement, at least, maybe it's not perfect, but correct, right? Like, at least roughly capturing what we think it's capturing. Because at the end of the day, you have this uncertainty variable, right, that you can't get rid of. So it's like, let's try to focus on something that we actually can do, which is fixing the measurement problem of the data.
Tracey, how do you deal with the corporations, especially?
Well, I would say in getting the right data, just Bob had talked about oil and gas companies. That's what I know. One thing that we're not getting data on are oil price assumptions for Exxon and Chevron. BP and Shell wrote down huge assets, huge stranded assets, but they disclose what they're using for price assumptions. We can't compare what Exxon and Chevron are doing. So we're not getting that data. But also, you're right, it's so hard to balance all that information, and that's why engagement is really important. Our investors engage, and that gives you, all the data is backward looking. If you can sit down across the table from a director, CEO, CFO, you get that forward looking view, and that's really valuable. And one area that I think scenario analysis has really, really been helpful in is getting boards and companies to think long term. I remember sitting across from directors saying, what's your 5-year plan, and how does that relate to your compensation plan? And I got deer in the headlights, and I thought, this is Director 101. You should be thinking long term, but this is forcing companies to think beyond 1, 2, 3 years. But it's tough. It's a tough environment, and we're the Wild West. We're just getting started.
So we have lots of questions in the chat, and I want to at least leave 5 minutes for live questions from the audience. So I'm going to go through these questions that we have in the chat quickly. So if everyone can keep their answer to 2 minutes, and then we'll go to the audience. And they're not all for Bob, but the first one is for Bob. Bob, and I swear this was not a placed question as far as I know, could you please describe your group's rapid transition fund in a bit more detail? ? Can you, you're on mute right now, if you could unmute yourself and just quickly describe a little bit more about your fund.
Sure, happy to, although obviously, 2 minutes, they can't say a lot, but I would say that I described that stranded asset swap, and that's kind of, 101. You want to be short fossil fuels. Then in addition, you want to look at which of the companies within those sectors are going to be performing better than others. The swap was really market cap weighted. And so obviously you can do better than that. You can try to identify this company that has, expensive sources is going to be more likely to have a problem than this company that has cheap sources of oil. And you don't want to just focus on the energy companies, because there's implications for all kinds of sectors in the economy, utilities, obviously, autos, airlines, materials, etc. So those are, a broader set of sectors you certainly want to look at. You can look at, from a top-down perspective, which countries are going to be more impacted than others. And that's an interesting geopolitical view. On a relative basis, Saudi Arabia, that has cheap oil, is going to continue to produce. But if you're Canada or Russia, you're an expensive producer of oil, and you're likely to be much more negatively impacted. If you're a importer like China, you might be in better shape because the prices of your imports are going to be lower. And then again, there's plenty to look at on the long side, including such things as carbon allowances. The California allowances to us looked very interesting. During the COVID crisis, they got down to about $11 a ton. They're now back up, I think, to around 17 or 18. They have a minimum auction price that's around where they are today. And that auction price goes up at 5% real per year. So, it's not guaranteed that the secondary price is going to be above the auction price, but if there's no, if it goes below it, there's no auction. And so the supply gets reduced. So you basically have, kind of a 5% guaranteed return with plenty of upside on those allowances, which is why we think they're interesting. So that gives you kind of a flavor of what we're doing. And, I'll stop there.
Thank you. And we will try and follow up with people if we don't get to your questions. If we can get an answer, we'll try and get you one. Or if you want a more detailed answer, bug us and we'll see what we can do. Another question, I think this one is for this is probably, well, I guess, Maria, I'll give you this whole question and you can answer it as succinctly as you want. You may want to go for a succinct answer. How can managers incorporate concepts of fat tail climate risk within the prudent risk management framework used in their fiduciary role? How is MassPrim incorporating these concepts?
So I think it gets to the thing that I said at the beginning is ESG means different things to different people, right? And ESG means how to, in terms of the environmental side, what, defining the fiduciary role or understanding what your fiduciary role is different depending on who you are, right? And so at MassPrim, we have, a very specific legislative mandate to focus on. And so for us, the way that we're going to tailor our approach is significantly different than, let's say, some endowments, for example, or different asset managers out there, right? And so what we're doing is trying to think about this issue, these risks in general, whether it's emissions related, and try to be able to model those risks and feel comfortable with understanding how we are exposed to them. But at the end of the day, we need to make sure that everything ties back to our risk-adjusted return, right? And so you have the data issue that you need to fix first to be able to start understanding how these different things turn into investment strategies that will enhance our risk-adjusted return target.
Thank you. All right, this is a question for Tracey. Again, it's the first part of this question I think anyone could have answered, but the second part is specifically for Tracey. So in the interest of time, we'll just ask Tracey it, and then again, we'll try to do a follow-up. Describe any first mover advantage to incorporating climate risk, particularly for those in fiduciary roles with long-term horizons / holding periods. Won't carbon be priced in eventually? Tracey, do companies respond well to such business cases? What is the typical pushback? By that, I think they mean, do they respond well to this idea that there is a first mover advantage to doing this?
I'm not sure. Certainly not for U.S. oil companies. There's no feeling that they should be
known for responding to these kinds of questions.
No, but I think generally there is. It depends on the company, and it all goes back to governance, right? It all goes back to your leadership and what their interest in looking at the science, looking at the headwinds that they're going to hit if they don't start. I mean, we have to get emissions down 45% in 10 years. That's a rapid, deep shift. And if you don't have a board that is looking at that, then you know, they're not going to be a first mover. But if they are, yeah, there are advantages. I think, you know, we work with a number of companies that are taking those roles and making those large commitments to, you know, be carbon neutral or, you know, whatever. But it's slow. And, you know, I think looking at the work that Bob is doing with CFTC, I think that is so incredibly important, just to change the whole structure, because, you know, I came from an asset manager who is, you know, their mandate is you need to hit your quarterly numbers. And if you don't have a structure in place, like the CFTC will help, you can't work on things like just transition. They take time.
So kind of, I mean, what I'm taking away from this conversation broadly is you need all of the above. You need every one of the elements that we're talking about in this conversation to see the change that has to happen and see it happen in the speed that it needs to happen, right? Policy has to happen, but stakeholders and others are going to help with that. You know, companies have to change. Engagement is important, but engagement alone won't do it. Investors recognize that there is a risk, but they alone can't get there, and they need to be empowered with the tools to really make those judgments. And if all of those things come together, then, you know, we can see that change in the time that we have left. You know, absent that, you know, we're in a lot of trouble. All right, in the last 5 minutes, with my dogs barking in the background, is there anyone? I apologize. Is there anyone in the audience who would like to raise their hand and ask a question in the final few minutes that we have? If not, I do have another question. I have many more questions. Somebody sent a question. All right, let's see. What did Q&A? Somebody wants to ask about bets on the November election scenario, but I don't want to ask that. Well, I will ask that question last, because I have a question before that, which is, what is the stranded asset risk to banks, right? So there's been a lot of great work done around how much banks are financing the fossil fuel industries. Is that a material risk to them in the way that, you know, subprime stranded asset risks was, or is that risk off their balance sheet and therefore it's not going to matter? Bob, and does this again speak to, presumably banks would be considered a scope 3 carbon emitter. So does this again speak to the idea that we're not necessarily framing these risks up right? Bob, you could obviously answer that, but I would also like to hear from others as well if they have an opinion. Let's start with you.
Well, I would have to defend the fact that if you look at from a bottoms-up perspective, which of these oil companies are going to be at risk, you're going to look at a lot of things before you look at their scope 3 emissions. And now if I'm a bank and I'm making a loan to an oil company, I should be looking at the real risk to that loan, and that's going to be a function of standard credit analysis for that company. And I don't know that scope 3 emissions comes into it. It's true.
Do you think banks are doing that analysis? Like, do you think, is JP Morgan more at risk than, I don't know?
I think there are a lot of folks that are very concerned about climate risk, appropriately so, that feel like they can put pressure on banks by forcing them to disclose scope 3 emissions. Well, scope 3 emissions, I don't think are, first of all, that well defined for banks. Am I responsible for the emissions of the car owner who, burns oil that comes from ConocoPhillips when I make a loan to ConocoPhillips as a bank? I don't think that's the right way to think about it. I think that emissions are important from a macro perspective, and we've got to get them down. But I don't think the way to do that is to focus attention on banks and try to prevent them from making loans to fossil fuel companies. based on the risk, based on the scope 3 emissions. So I'd have to side on the side that says, I think this is a little bit not to the point. The point is, we got to price emissions, and the financial community can't do that on its own. Banks can't do that on its own. Oil companies can't do that on their own. Frankly, right now, in large part due to the good work of Climate Action 100 Plus and Ceres and asset owners, banks are now saying, look, we get it. We've got to price emissions, and then people can make the right decisions about when and where and how they burn fossil fuels if we price in the risk. It's not that everyone's going to stop using fossil fuels, number one, and it's not that it's evil to use fossil fuels, number two. It's that we're not pricing the risk. And the financial markets can't do that on their own. That's got to be the political, decision, and it's the politics that are preventing it, not the bad behavior of banks or anyone else.
Does anyone want to follow up on that? If not, that seems like a very appropriate point to end it. Tracy, did you have something to say?
Just very quickly, when the
you're on mute. I don't know why you're on mute, because you don't look like you're on mute.
Can you hear me now?
Yeah, I can hear you now.
Just very quickly, with all the price volatility that we saw a couple of months ago, for the big banks, I get it wrong, but I think it's Wells Fargo, Citi, JP Morgan, Bank of America, all set up entities to take on stranded or fossil fuel assets that were bankrupt. So it's already an issue with the banks,
So yeah, that is also an interesting point. All right, final question from the Q&A. Any bets on November election inflation scenario? Does anyone want to talk to that?
Inflection, not inflation.
Inflection, good point. That's my dyslexia for you. Now you have to answer the question.
I'm happy to take that on. I would say, look, this is going to be a blue wave. And, I don't think that climate is going to be a driving issue in this election. But, I think the pendulum has swung way too far in one direction. It's going to swing back very sharply in the other direction, hopefully in the direction of, rational policy. And rational policy is a strong incentive to reduce emissions. I expect that to happen early after the election.
See, on the one hand, it makes me nervous that you say that because you're tempting fate. And on the other hand, you are one of the most highly regarded risk officers in the world. So maybe that should make me reassured.
Well, let me say this, Imogen. I'm not an expert in political science, but I do chair the board of something called the Niskanen Center, which is a political science think tank in Washington, which basically actually has a lot of former libertarians and Republicans. And they have a good political scientist there, Rachel Buttikofer, and her view, and she got, by the way, the 2018 midterms exactly right. She said, today, it's not over fighting over the middle. Today, it's over motivating both bases and who's going to be more motivated. And right now, her view is that the Republicans are holding their nose and the Democrats are very motivated. So I hope she's right, but her view is it's going to be a wave election, and that's my view as well.
Okay, well, great. Thank you for that, and thank you to all our panelists for a really interesting and engaging conversation. Alyssa, are you gonna just close this out?
Thank you, Imogen. I sure will. First, thank you very much, Imogen, and to our panelists who joined us today. So much to think about for moving forward. And also thank you to the team for helping put this together. High Water Women has launched a membership network. Our goal is to create a network of investors and interesting parties who care about learning more. And if you become a member today, you can receive advance notice of upcoming sessions and discounts on purchasing tickets and other networking opportunities as the world allows these days. I want you to make note of our upcoming sessions. We have another one in just a few days on July 17th on gender and diversity lens investing, followed up quickly with a session on portfolio construction in August, and we'll return to our climate work stream in September with energy markets and the renewable economy. Again, thank you to our panelists and for our members, and thank you all for attending today. And of course, to our underwriters who support this work. We're a small nonprofit dedicated to empowerment and education, and we do that through the kindness and support of others. So thanks once again, everyone, and have a beautiful day.